What if I told you that picking individual stocks, the thing most new investors obsess over, is actually not how Warren Buffett recommends you build wealth? That's right. The greatest stock picker of all time doesn't tell everyday people to pick stocks. In fact, he said the opposite again and again. And once you understand why, you'll never look at your portfolio the same way. Most people jump into investing by grabbing whatever stock is trending on social media, hoping it's the next big winner. But Buffett has warned for decades that this approach is one of the fastest ways to lose money. So today, I'm going to show you exactly what he recommends instead. This is Tomas, and on this channel, we simplify finance and automation so building real wealth doesn't feel complicated. Before we get into it, hit that like button and subscribe if you want more videos like this. It genuinely helps this channel grow, and it only takes 2 seconds. Alright, let's break down why you should stop buying individual stocks and what to do instead. Let's start with the biggest problem with picking individual stocks. You're betting against professionals who do this full-time, with better data, better tools, and teams of analysts behind them. Even Buffett himself has said that most professional fund managers fail to beat the market consistently. So if the experts struggle to win at this game, what makes the average person think they'll do better picking stocks based on a headline or a hot tip? Here's the second issue: concentration risk. When you buy individual stocks, your entire investment depends on that one company's decisions, leadership, and industry trends. If that company has a bad quarter, faces a scandal, or gets disrupted by a competitor, your money can disappear fast. Buffett himself only invests in individual companies after decades of research and deep understanding of their business models. Most people simply don't have the time, tools, or experience to do that properly. So what does Buffett actually recommend for everyday investors? Index funds. He has said, on multiple occasions, that a low-cost S&P 500 index fund is the best investment most non-professional investors can make. Instead of trying to guess which single company will win, an index fund spreads your money across the 500 largest companies in America. You own a small piece of Apple, Microsoft, Amazon, Google, and hundreds of others, all at once. This matters because diversification protects you. If one company crashes, it barely affects your overall investment because your money isn't sitting in one basket. Meanwhile, if the market grows over time, which it historically has, your investment grows right along with it, without you having to predict anything. Buffett has even put his money where his mouth is. He famously made a 10-year bet with a hedge fund manager, wagering that a simple S&P 500 index fund would outperform a group of hand-picked hedge funds. Guess what happened? The index fund won, by a landslide. This wasn't luck. It was proof that low-cost, diversified investing beats most attempts at clever stock picking, even from professionals. Now let's talk automation, because this is where everyday investors actually win. Instead of trying to time the market or chase individual stocks, set up automatic weekly or monthly contributions into an index fund. This is called dollar-cost averaging, and it removes emotion from the equation entirely. You're not trying to guess the perfect moment to buy. You're consistently investing, whether the market is up or down, and over time, this strategy smooths out volatility and builds wealth steadily. Another key point: fees matter more than people realize. Actively managed funds and individual stock trading often come with higher fees, taxes from frequent trading, and emotional decision-making that hurts returns. Index funds typically have extremely low expense ratios, sometimes a fraction of a percent, which means more of your money stays invested and compounding over time, instead of going toward fees. And finally, remember this: Buffett isn't telling people to avoid the stock market. He's telling them to avoid guessing. There's a massive difference between investing and gambling. Picking individual stocks based on hype is gambling. Consistently investing in diversified, low-cost index funds over decades, that's investing the way Buffett actually recommends for people who don't have his time, resources, or expertise. So here's the bottom line: you don't need to pick the next winning stock to build real wealth. You don't need to guess, panic, or chase trends. What you need is a simple, diversified strategy, consistent automated contributions, and enough patience to let compound growth do the heavy lifting. Warren Buffett has access to more information and resources than almost anyone alive, and even he tells everyday investors to skip individual stock picking in favor of index funds. That should tell you everything you need to know. If this video changed the way you think about investing, smash that like button, subscribe for more finance and automation content, and let me know in the comments if you're switching to index funds. I read every single one. This is Tomas signing off. I'll see you in the next video.